Hello. Hey, how's it going? Good morning to you on this wonderful Thursday. Just getting lots of music in my ear, but we have, of course, the dulcet tones of Aaron as well. Welcome to the show, Aaron.
Thank you very much. Very happy to be here bright and early.
We are having a real exciting time, all at home, but our trader friends are seeing the amazing behind the scenes pictures. I don't know whether, Aaron, you've seen our beloved studio uh, currently being refurbished. It's about time as well.
Yeah, it looks
And
exciting. Walking
I
past it, seeing
know
all the screens being moved around, and
I've
yeah, it should be exciting. Looking forward to getting back in there.
I've had so many people message me to say, Ange, what's happening? Have you guys gone into liquidation? Are you selling off kit? We're auctioning off chairs that have been sat on by Rich and myself. And I said,
Signed memorabilia you could sell.
yeah. And the our trader friends, of course, are in the know. Unlike the some of the rest of the staff is at IG. We are giving you a brand new studio, which will be unveiled hopefully in the next few weeks. And I can tell you, the camera guys, our wonderful gallery team, have been hard at work. The green screen paper came off yesterday.
Exciting stuff.
Ah, yeah, let's do the coming up because it is a big day and even bigger on Friday. So let's see what we have in store.
So we've got overnight action coming up now. 8 o'clock is the opening bell with the two of us, Angeline and Aaron, and then 8:15 fast markets, Angeline Ong and Luke Cooper. 8:30, I'm back with Martin Harris on the man versus machine segment, which is a great segment on whether two portfolio managers can beat a machine. So tune in to see whether we can or whether we are so far. And
Very excited about that.
9 o'clock, we've got the opening bell with yourself, Angeline.
Yeah, and it's going to be a very interesting day. Given we saw, that potential sign of rotation from tech into some of the other defensive stocks in the previous session. It'll be a good one to see whether we see a continuation of that today, or was that just a blip? What do you think, Aaron? Do you think it's time for that rotation, or do you think we're just way off yet?
I think it's certainly coming. I mean, we're seeing tech stocks are pretty much at their 2002 values, give or take 2001 values pre-crash. So I think we started to see it sort of earlier in the year, not necessarily within US equities per se, but we saw it, US equity investors move some of their positioning towards the UK and continental Europe, which has been quite a successful trade for many. But yes, certainly I would expect to see a degree of rotation continue as we see elevated valuations, and if we see any optimism fades, which looks like we might be seeing soon.
Right. Let's go to overnight action now. Stay where you are, get your coffee and tea, but don't go away because it's just a short sting and we'll be covering overnight news. Hey, welcome back. So, loads to cover overnight, but also, I know that you don't ever sleep, Aaron, because whenever I message you in the evening, you are awake and you respond back almost immediately. It's like magic. Quite scary that. But we had, of course, the news coming out of Gaza as well. You've been calling this for some time, haven't you? 60,000, big number there.
Yeah. I mean, I've said that the situation in the Middle East with Iran, its proxies in Israel, it sort of tends to bubble under the surface and then come to a head every now and then. So we had a situation in June where there was sort of conflict between Iran and Israel. Now we've got more potential conflict going on in Gaza as there's a proposed invasion of Gaza City where Israel wants to deal with Hamas's leadership there. So yeah, that could certainly spook markets if this sort of continues for longer than expected. And yeah, definitely could see a tailwind for gold as we sort of see more geopolitical concerns and springing up in the Middle East, and this certainly has the potential for sort of more contagion with others in the region, with Iran potentially getting involved directly with Israel again if this continues, and they if they're not keen on what Israel's doing.
Now, Aaron, this is going to be interesting for defense stocks because they have been down
Mm,
recently
yeah,
due
yeah, yeah.
to the mood music coming out from Trump and Zelensky.
Yeah.
Expectation there that there will be some sort of deal coming through. And we're also seeing, of course, that reaction to Trump essentially taking or enforcing that cash flow redirection, if you like, from European weapons makers to the US. Do you think this Hamas Gaza situation has the potential to offset the flows that we've seen recently?
To an extent, I think you've got a bit of a dichotomy with the US, Ukraine, Russia situation, because that seems to be cooling somewhat with the Alaska summit and meetings with Zelensky, Putin, and Trump. So if we see cooling there, I think that's probably where we're seeing more sort of weapons demand, more defense stocks are likely to rally in that region. Israel's known for producing a lot of its own defensive goods, but certainly they could get a strong tailwind if we see sort of continued conflict in the region, because as you said, beaten up quite badly in the last week. I mean, looking at sort of a broad defense ETF down sort of in excess of 3-4%,
Mm.
given the sort of positivity of the talks with even though nothing's signed, the positivity of the talks between Putin and Trump, and now more recently earlier this week with Zelensky as well.
Plenty else happening overnight. I got up earlier today to crunch some numbers for you just to get you across the top news. We've had so much out of the US as well. We've had Target stock falling, just whacking up my chart for you, my graphic, after the retailer named the insider Fidelke to the CEO role. Intel also another one that is really. Let me just try and share my screen again here. For some
Well,
reason, it
Intel's
is.
had an
Here we are.
interesting story, because it's been, there's been potential deals with the US government and tariffs, and it's been quite heavily involved in that. So we've seen quite a lot of volatility, particularly in that stock in particular, over the past sort of week or so.
Yeah. So it's huge really. The Intel news continues to keep giving as well. We saw this earlier in the week about that capital injection
Yeah.
for SoftBank, but now CNBC is saying that it's also talking to very large investors for more cash infusions into the chip maker. This is seen largely as a positive for Lee Bhutan because, even though he has such he's so respected in the field, there is an awareness that it will take him time to, put his turnaround strategy into place. And so these capital infusions do just that for Intel. Lowe's as well agreed to buy foundation building materials for more than $8 billion there. So that made headlines overnight. And also, what I found really interesting, especially given we are now in the run up to Black Friday, Thanksgiving, and also, end of the year, Christmas shopping, Amazon ditching its homegrown software for Android in its Fire tablet revamp. It looks like it's just going ahead and there were all these plans for it to provide its own software in its Fire products, but now it looks like it's given up that goal.
Yeah, maybe they can see better margins elsewhere
Yeah,
using software as a service from another
yeah,
provider.
right. Or maybe too many people who use Fire are used to the Android operating system. I
Hmm.
know there's certainly a lot of Android users in our gallery, a lot of hardcore, you know.
I'm
I
iPhone
hear
through
a
and
whoop.
through.
Are you an Android or are you an Apple?
No, I tried Android once for 2 years,
Yeah.
and I just couldn't get the hang of it. As soon as I got it, about a week afterwards, I was sort of missing my iPhone. So I think for the past 10 years, I've been a loyal Apple user.
Do we hear a poll out there, trader friends? Do we hear a poll? Are you an Android or are you a true blue Apple user? Let us know if you can, because it'd be interesting to see what the percentages are. Coming up a bit later, I'm going to move my screen over for you. We have, of course, a huge number of things that we are looking out for, including Walmart. We've also got that Jackson Hole symposium that we have been banging the drum to. Lots could happen out of there. Not forgetting the fact that any comments from JP, from Buffett, could really move markets. This is expected to be a very, very hot summit because Powell could lay out more ideas, give us more clues about his policy framework, whether or not we could still see these cuts this year. He might even give us a hint as to when he might be looking to step down, or whether he's going to see it to the end of his term. What do you think we're going to hear out of there, Aaron?
Well, I think the Jackson Hole Symposium is always quite a volatile event. I mean, I think everyone remembers their first Jackson Hole. But I mean, one that really sticks out to me is 2022, where it was sort of a bloodbath for markets after that. So I think, if he starts whittering on about concerns about rate cuts, whether they might not be projected to fall as much, we could see volatility on the downside in equities. Also interested to see what he says on the US economy and the state of the US economy, because what he says is very quickly digested by markets, and they tend to react quite heavily to this conference. So certainly a very high impact event, certainly one to keep an eye on, and be aware of sort of some volatility around this.
Yeah. And then, of course, Walmart, a big one to look out for, because everyone watching to see whether or not Walmart can show that it is managing to keep consumers and customers coming into the stores and its tills ringing. And we all know that Walmart has been trying to steal market share from its peer Target and also fight off the online pressure from Amazon as well.
For this
It's
one,
key.
I
Yes.
think with Walmart, I think that their guidance is going to be quite interesting, particularly regarding how the tariffs have affected them, because they're now starting to see, we've had what, give or take 5 months or so of tariffs. So I think this is going to be an interesting time to see, well, has it been baked into any of their earnings, these effects of the tariffs, and how much is it affecting the consumer, or have they been sort of front loading and it's not affected too much? Really interesting to see what their earnings look like, and also their guidance.
Yeah. I mean, it is a behemoth, and operating income seen at $8.7 billion. We're looking for 10% year-on-year growth. That is the expectation there for Walmart's earnings. But as you heard Aaron rightly say, it is going to be what it says about the tariffs. Will it see a big impact? And also the fact that its business, right, has been really converging over the years with Amazon's as well. Are you familiar with their delivery multi-pronged strategy over in the US, Aaron? I know you've got lots of family over there.
No, I haven't heard of that. No.
So when I was last there last summer, I was surprised by how many different ways you could pay for a Walmart delivery. And it's trying to fend off Amazon, which has the same offering. So you could pay, the cheapest tier is just a normal delivery, like we know it here. Then Trader Friends, there's that second tier where you get them to put it for a bit more money. They put it in your garage, and they've got your security or your PIN number, so they put it in your garage for you out of the sun. And then there's another tier where they put it in your house. But there are two other tiers above that. One is they fill your fridge for you, and there's also a top tier where it feels like, do they make your dinner? No, unfortunately, they haven't got that far yet. I would be interested in that tier.
That's the AI update that they're going to introduce.
That is the AI update, and I want the AI update as well to stop my secured IG laptops from timing out when I haven't touched it for a bit. Uh, so yeah, it doesn't make your dinner, but it does almost lay it out on your worktop by by ingredients. So it's got like dried and it's got perishable. So it lays it out for you. Someone lays it out for you on your worktop. So when you come back from work, you can see everything that you've bought and you know exactly where to put it.
Very impressive.
I find it very, very odd, but they all come in with body cameras and stuff. Not my cup of tea.
No, so that means they can't steal anything, hopefully.
Yes. So let's have a look at what else is going on in the world. Of course, the FT, we've got headlines on China as well, and this AI chip story turning against the AI chip that NVIDIA makes after Lutnick's insulting remarks. I'm going to try and put that up for you. Yeah, so this is a really interesting story because remember there were all those reports swirling around the chips that were being sold to the Chinese, the H20s having kill switches.
Mm-hmm.
Uh,
Yeah.
uh, yeah, and so now it looks like there's more from more evidence or more reports really that this could be true. I don't know whether you've seen any data proving this yet. So far, I've only seen reports, trader friends, not seen, I've been looking to see for any concrete evidence, but haven't seen that yet. Please let me know if you have. But apparently a group of regulators over in China have looked at efforts to dissuade domestic tech companies from using and buying the H20. This is the watered down processor that is widely used for AI in China.
Interesting stuff.
So Trump did actually get his administration to lift export controls, but this was on the chips that apparently had less capabilities. I wouldn't say less fast, but Lutnick from CNBC said, we don't sell China our best stuff, not our second best stuff, not even our third best. So this was on CNBC on July 15th, the day after the Trump administration lifted export controls on H20 sales.
Also my birthday.
Ooh, yeah. So I'll never forget that date now, Aaron. Ooh. But you see, this is the problem. This is the key issue with the story. NVIDIA knows that it has to keep China buying its chips, right? Because if you don't sell them the chips, then and they can't get their hands on it, then soon enough they develop their own. And boy, do we know that the Chinese are really fast at developing something when they put all their efforts to it.
Yeah, that's definitely the problem. And then NVIDIA also doesn't have a sort of strong recurring revenue stream as well. So I think there's a win-win for NVIDIA there.
Yeah, so this is a real tightrope for NVIDIA, right? Because China has been really, really provocative, very vocal about how the country should have more R&D spent on their own domestic AI type chips, those chips used to drive AI. And Alibaba and names like ByteDance have all argued that their AI development would be hurt without those NVIDIA chips in the first instance. So we'll be keeping a close eye on this arms race, a really interesting one there.
Certainly, indeed.
Right, let's have a look at the economic calendar now to see what could be great tradable and investable events throughout the week. Let's pop that up for our trader friends. There we are. So we are, first of all, waiting on that flash PMI numbers. Aaron, take us through some of the others.
I can't actually see it on my side.
We've got existing home sales for the US coming out a little later in the day. And then we've also got on Friday, of course, inflation numbers from Japan, but the key party of the week, of course, the Jackson Hole event and Powell's speech on Friday is also expected. There we are. So do let us know which ones you are watching, which ones you are potentially trading. We'd love to hear from all of you. I know there's been a lot of activity on the chat as well. The poll as well has been up for some time. Please let us know whether you use Apple or Android. Right, I've been told by Phil the poll's just finished. Aaron, can you see that on the show? Ah, probably can't. So I'll
No,
take
I
you
can
through
see
it.
the Claude screen still.
So we got 48% of you saying Android always, and 41% saying True Blue Apple fans
I'm
there.
surprised it's that low for Apple, to be honest.
Yeah, I mean, like, this is what creates a market, right? We've got almost like even split there. I love that 6% other phones are available, guys. Let us know what the 6% use, and 3%
I remember
mind
when
your own business. Is this
when
Phil?
when the iPhone came out, I
Mhm.
remember that Microsoft CEO said that it will never take off. Steve Ballmer at the time, and I think he got that one slightly wrong.
Boise, I love your comment saying, Asda, just throw it over the garden wall. Tim Apple saying there's only one phone provider for me. I wonder if you work for Apple or the like. Julian, good morning to you as well. And Faisal Mali, good morning to you. I see you quite often on Discord. Jugga, Yaga, saying Apple, but I might switch to Android. I can tell that Phil's Android phone is the size of my face. I do have screen envy sometimes. Right. Time for the best moment, or rather, my humble opinion, one of the best moments on Trade Live with IG. It is Guess the Chart. Right, producer Phil, is it US or UK? What is it? It's a US stock. And any hints, Phil? Yeah, he said absolutely not. Right, let's go to Aaron. You ready? Trader friends, ready? Here we go.
It's green, it's red, it's looking tight. A breakout move or fake out flight. 2-week dip or pump in stealth. Guess the asset, guess the wealth. Head and shoulders, double top. Diamond hands, or should I stop? FOMO buys or capitulation. Guess it right, earn your station. Fibs and zones, they try to fake. Is it Tesla? Is it cake? Zoom in tight, you've got the heart. Now light it up and guess that chart. Guess the chart, win or lose. Rug pull trick or daily news. Read the rhythm, play your part. One last call, guess the chart. Producer Phil's got tricks up sleeve. He'll throw a curve and watch you leave. Rich is cool, but don't be fooled. He's seen more charts than you've been schooled. An angel mate, she's sharp as steel. Guess it wrong, she'll close the deal. Guess the chart. Guess the chart. Guess the chart. Guess the chart.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hey, trader friends! Winner, winner, chicken dinner. We don't have a winner yet, so come on. We still have time. Funky Gibbon coming out with Flutter, Ente No, Steve Davies, JP Morgan. That's not it either. Ron coming out with some tech names, but it's
All
not
wrong,
it
I'm afraid,
either.
for me.
Jug. Right, Marco Polo saying Oracle. Here we are. It is Broadcom. Wow. Yeah. Well,
I'm happy I got the industry though, so I'll take that
yeah,
as a small
I know.
win.
I think you were, yeah, but Aaron, you were going through every single tech name.
I know. I was like, I was just trying to sort of list one just to hope I was right, not really looking at the chart.
And then we were kind of like, yeah, Aaron, every single tech name had that
Bound to get
dip
one.
in April, went back up again. Speaking of which, Richie Rich was at the Fringe Festival recently, and he, of all places, had to be him, found a tent that had gold trading, a gold trading tent in the Fringe Festival.
Did he? I couldn't find it when I was there.
I mean, it turned out, of course, a comedian, but I was like ribbing him about had to be you that sat in there, and apparently the comedian used an IG account for his skit.
That's funny.
What did you catch at the Fringe?
I saw all sorts of things. I actually saw a very interesting musical about Bill Gates and Steve Jobs. That was quite funny. I saw a lot of stand-up comedians, which I seem to be the brunt of a lot of their jokes for some reason. I'm no idea why.
Did you sit too far in the front?
Yeah. So my friends always quite like sitting by the front to get roasted by the comedians. But it was good fun. I mean, we saw some great acts. So highly recommend visiting Edinburgh in general, but also the Fringe is a fantastic time to go. You get to see some really interesting comedians, including some ones just in a pub where it's like 5 people who are actually hilarious. So highly recommend it.
How do you know whether we're just going to quickly look at the markets now, because we are very close to the bell. You've got your hand on the buzzer ready, Aaron, for the digital bell that we're using.
Metaphorical buzzer, yeah.
And yeah, metaphorical. This, of course, is a day coming after the Nasdaq and S&P fell Wednesday. Investors selling off on those tech stocks, and we saw this very early start. I mean, not quite sure whether it's a big move yet, but we did see a small start of tech stocks being sold off and investors moving into less highly valued sectors as well. So how many seconds have we got to go, guys? 15 seconds to go there. And I'm going to get my chart ready to make sure that we've got all things set for the open. 3, 2, 1, here we go.
So
Here we
US
are,
tech.
and we are off. Let's have a look. It is looking pretty quiet out there. Iran, we've got quite a flat day
Yeah.
across. Yeah, FTSE is just flat there, just slightly higher. Germany 40, also flat, and also the CAC 40 down slightly. Let's have a closer look, a magnifying glass on the FTSE first. And don't know if you can see my screen there, but Aaron, I'm going to put up the
Yeah. We've
winners
got a
first.
little bit of a comeback from some of those defense names there, BAE and Rolls-Royce, which sort of dabbles in that field, up almost 1%.
Mm.
Rio Tinto up 0.5%. Got some of the bankers up as well. Barclays, Lloyds up around 0.5%, and then even the likes of Scottish Mortgage doing fairly well, up 0.3% today.
Yeah, Aviva, those of you with positions in Aviva also moving higher there. Let's have a look at the losers as well. Legal in general down almost 2%,
Yeah.
and Schroders down about the same amount as well. We also have Relics, which is a defensive, that's down 0.5%. Smith and Nephew also down there. Any of those other names jump out at you?
I think Relics, if we go back to the one in particular, it's been on such a tear. It
We
might be just a
have.
touch of profit taking. I mean, barely 1%, but yeah, I think I would say that one. But yeah, I mean, sort of we're seeing not significant moves on the downside, I'd say, apart from LNG and Schroders, really.
Yeah. Also, EasyJet is down slightly as well. We're also seeing some of the drug names on this list. There are GlaxoSmithKline and also AstraZeneca. Right, let's move on to Germany now, because Germany, we've recently seen it slightly hesitant there because we've had many of the big defense names pulled back, but with the news out of Gaza, that might change. And then we have
Yeah.
it, Rheinmetall.
Yes, making a comeback based on, well, potentially that news.
Yeah, it's up about 1% there. And Infineon Technology is also up 0.5%. MTU, Aero Engines, RSAX, is that one of yours? Up slightly. Right, let's have a look at the losers list, Aaron.
Yeah, so Simrise down just over 1%. Adidas also down 0.8%. Siemens down 0.5%, and Bayer, which is a pharmaceuticals and healthcare company, down 0.5%, and Porsche as well down 0.3%. So some interesting moves on the downside, but also the magnitude of them is not particularly large, I would say.
No. Would you say this is more sort of investors sitting on their hands ahead of Jackson Hole?
Absolutely, yeah. I think you've hit the nail on the head with that. We're likely to see bigger moves, potentially on the up or downside, depending on the sort of rhetoric Powell engages in, whether it's, you know, we're going to see a barrage of rate cuts that might spur on certain elements of the stock market, assuming that he doesn't criticize the strength of the US economy. So it's a bit of a balancing act he's got. So yeah, that's why you're seeing sort of these fairly muted moves as people are awaiting what is quite a volatile speech.
Yep. Parky 1977 also coming on saying legal general ex divi there, and we've got some other movers that we're going to check on. Let's have a look at France now, because similarly as we saw with Rheinmetall, we're seeing, you know, Safran come up a bit, bouncing
Total
back.
Energies is up a bit as well.
Yeah, exactly. And Thales as well, regaining some of its composure there after the last few days where we saw moves down. Also, having a look across to the losers list, it's more of a risk-off day, as we said early on. We're only a few minutes in, but we've got L'Oreal down more than 1%. Not been using enough of their face creams, Aaron.
No, it's all right. I managed without, I guess, in Edinburgh.
Yeah. Credit Agricole is also down 1% there. And we've got the likes of the luxury stocks. Rich and I talked about this early in the week. This might be a good moment to, if you're looking at, you know, buying some of the more higher end luxury names like Hermes. because I am looking to do so as well. We've still got worrying signals coming out of China, and also Chinese tourists not traveling as much as they used to. By that I mean pre-COVID. And so we are seeing some of the luxury names a bit lower the last few sessions. And, you know, if you look at Kering's share price, you can see that it's, you know, trying to get back up to where it was, but it's still quite a way off. That's quite a nice, this is a daily chart there on my right, people. And if you like inverse polarity, this is a very nice inverse polarity chart there. FTSE has been looking strong this week, Boise. That is right. And in fact, you know, when we kicked off our new studio build, we kicked off in style because the FTSE and European stocks were also on a high. So let's have a look at the indices now. Yeah, the FTSE has had a pretty good week. I'm going to zoom in there for you, if I may, on my chart. It is quite an interesting one driving this from home because, of course, our monitors are a lot smaller, but we make do. So here is the chart here. This is the daily chart, and that is the weekly chart for you there. So as you can see what Boise was saying, it has had a very strong week. The DAX as well. Let's have a look at the DAX because I'm sure we'll see a similar picture there for you. Here we are. So this is the 30-minute, but let's go to the daily and then go off to the weekly there for you. The DAX not as well as the FTSE actually. It's so far down 0.5%. Let's have a look at some of the other movers. You saw that some of the defense names were lower. Another one that is bouncing back is, let's have a look. We had, I think I saw a headline earlier that Leonardo is also bouncing back. We've got the DRS here, but also another one that I want to check on is, let's have a look. We got SWH as well. WH Smith, rather. Whoa, that's a huge move lower. Thanks for that, Andrew McKelvey. WH Smith is down.
Taking a real beating today.
Oh, yeah, 30% there. So if you shorted that, well done you. Let's have a look for WH Smith. Any other movers that you've seen so far, Aaron?
Nothing so far. I think what I'm waiting on is to see the speech coming out of the US and to see the rhetoric coming out of the US. So that's why we're not seeing anything sort of massive, saying that with a stock down 30% on the screen, but we're not seeing anything massive out of some of the bigger names, Magnificent Seven, large FTSE and European names as well. As I think there's, you know, investors are waiting for a signal and the sort of direction of travel from the Fed and from economists at Jackson Hole.
Yeah. WH Smith there making this huge downward spike after it cut its profit forecast. This is because of revelations that it had an accounting error in its North American unit. This is an overstatement of around $40 million. That's right, $40 million in expected headline trading profit. So this is because the supplier of income from North America being recognized too early. So really interesting move there. Elsewhere, just taking a look at you know, the recommendations as well this morning, because we haven't yet got to that, but quite a quiet morning so far. We've got more price target cuts on Gerberit, Kepler Chevreux cutting the price target of that to 635 Swiss francs from 650. Okta also seeing its target price cut by Jefferies to 100 from 105. Not a big one there. Interestingly enough, we've got Target. Got, of course, numbers from Walmart a bit later. DA Davidson cutting the target price for Target from 115 from 125 after those numbers. So overall, quite a flat day if you like Trader Friends, other than some of
The
those
day of anticipation so far, I would say.
it is like the calm before the storm. Let's take a look at the commodities space as well to see whether we're seeing any sort of impact from the news out of Gaza. That
Nothing huge I'm
60,000.
seeing.
Yeah, not a huge response there. Oil is up around 1% there. That is the view daily chart there of WTI. Trader friends, any of you trading commodities, please let me know on the chat this morning. I know there are a few of you asking whether it's time to get back in to Cocoa or Arabica on Discord. Boise, loving it. FTSE always rallies on new studios. That's a new forward indicator by Boise and us. Gold, let's have a look at that because it is off slightly. Gold has been in this range, but you can see that it is struggling to break above that area of interest, which is around 3,360 to 3,000 rather, 3,370 there. So far as, in my humble opinion, so far as I know, as long as we don't get any surprises from the Ukraine side of things or indeed Gaza, we are unlikely to see gold break out from this channel. It's been stuck in for some time, really. If you see the two yellow lines there that I have drawn for you. Silver also calming down recently. We are seeing high-grade copper down as well, around 0.5%. Right, so we're going to go to a quick break, but we'll be back with Fast Markets.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Oh, yeah. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments like shares, indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hey, good morning, trader friends, and we are back with Luke Big Cooper. How are you?
I'm very well, thank you, Ange. How are you?
I'm very good indeed. I kind of
Good,
think we
good.
should change your name to Big Cooper, not Mini Cooper.
Then what are you going to call Luke Moore if I'm Big Cooper?
Luke
Big
Moore,
Moore?
my nickname for Luke Moore has always been Lucky Luke. Or
Lucky Luke.
for those of you trader friends, I know that you're there, but you're silent listeners. But I know you're there because you message me at dinner time. You message me at dinner time because they watch the show when they're eating dinner. I don't know why, but that is when they get their break because they have full-time jobs, very
Yeah, of
important
course.
jobs. They are as well. So those of you that speak Cantonese and you understand this, Luke Cooper, it is a big compliment. My other nickname for him is Lang Jai. That means
Say that
handsome.
again.
Lang Jai.
Lang
That
Tai.
means handsome boy, you know?
Thank you very much.
Like
I'm blushing now.
So how are things with you, Mini Cooper? I haven't heard from you for ages. Have they been keeping you, locked up in a safe somewhere?
No, I've been presenting with Rich. Obviously, I'm on today, and then from memory, Phil will correct me if I'm wrong. I'm on the 4th of September, presenting in the new studio, which I'm looking very, very forward to.
Fantastic, fantastic. I am looking forward to that as well because they are currently stripping off the wallpaper, or maybe
Yep.
they've done that already. But I saw pictures of it yesterday and was like, please put something back. So it'll be fantastic stuff. It is a bit strange doing it from home, isn't it? A bit strange.
I'm in the office today. I'm just in a little pod because in our office we have little pods near where we work. So I didn't want to distract everyone on desk. So I thought I'd come in a pod and then we can talk markets.
Yeah. Well, speaking of markets, it is looking like a flat to risk-off day. Morning, Pelican. Morning, Andrew McKilvey. And morning, Friar Tuck as well. Andrew McKilvey talking about WH Smith says, I'm going to add some because the drop looks overdone. Friar Tuck, his eye on goal there. Let's kick off with WH Smith first. Interesting news because
Down
of its
30%.
overstatement, right?
Yeah. So I come in the morning, and at 7 a.m. in the morning, the LSE on their website shows the RNSs. Okay, and what I do is I'd send them out to clients, and WH Smith was top today. I mean, on the equity front in the UK, it is quite quiet today, and WH Smith being the top does indicate that is quite important news, of course. Hence why the stock is down 30%. Because when I think of UK stocks, and particularly those larger ones, I don't really think of WH Smith anymore. I mean, I used to go in WH Smith a lot when I was younger, but now I don't really go into WH Smith. What about yourself?
I occasionally go for the Galaxy bar and I eat a whole bar in one go.
I wasn't expecting you to say that.
Occasionally, yeah. Or a 4-pack Snickers. I'm a big fan of Snickers. So yeah, it's a huge move lower. I mean, looked at the shares. Let me get it up for you for those of you that didn't catch it this morning. But it tanked. Last time I checked, it was just below 30% down, and now it's above 30%. Showing you my workspace there, if you can see that. So that overstatement, it actually put the income from its North American unit in early.
Yeah, I saw that. It'd be interesting to know. Obviously, I don't know off the top of my head how much revenue is from North America, how much is from the UK, as an example. But out of interest, what's our client sentiment on WH Smith at the moment? Are more clients long or more clients short?
Let's have a look. So at the moment, we haven't got any of the data, but I can tell you in terms of the fundamentals, divi yield 3% there.
That's
And
quite good.
yeah, that's not bad, compared to some of the banks, which are like, 6 or 7, some of them. Let's have a look at the tip ranks as well. We've got, it's got a neutral smart score, and the analyst consensus, 4 buys and 2 holds. This is based on 6 analysts giving ratings to WH Smith in the past 3 months. And if you want to dial in the view, trader friends, you can click the more button on the bottom right hand corner, and it gives you all the analyst forecasts and the details here. And you can also get the articles on the right hand side. I like this function. It's very, very easy to use. Whilst we're talking about retailers, it's also a key day for the likes of Walmart. Do you like Walmart? Do you ever shop there when you're in the States?
No, well, I've been to the States once. I went to New York. I didn't see a Walmart. However, I've seen videos online and they do look very, very, very big. Very big, that's what I can say.
This amazes me.
Go on after you, Ange.
What you can find in there.
What can you find there? Like, is it literally anything?
Anything and everything. They imagine the biggest B&Q that you've been to here and then times 4. That's like the size of an average Walmart. You can buy everything from fruit and veg to tires, even if you wanted to, baby cots. Not that I want one, but you could literally just take it and go. And they've got so much space. They sell everything. It's almost like being in some sort of warehouse. But the key thing to note, Aaron and I are talking about this and would love your views, Mini Cooper. The whole thing with Walmart, 2 key things. One is the outlook, what they say about tariffs. Are they already now starting to hurt the customers? And how much of that are they, how much evidence of that are they seeing? And are they passing it on? If so, how much? And the other thing too, which I think is more key, is the fact that Amazon has been eating into Walmart's business, and Walmart has been trying to also fend Amazon off. Lots of analysts out there say that they're converging. Angie's view is converging is not quite the right word for this. I think Amazon is eating into Walmart's share, and it's trying very hard. I saw a data point the other day that both Amazon and Walmart are on track. So both of them are on track to print $700 billion in sales this year.
Not bad, is it? Not bad at all.
Not bad. But a long time ago, Walmart was way ahead, right? Way ahead.
That's because obviously Amazon on the e-commerce front are very, very ahead. Whereas I felt with Walmart, they were quite behind. Obviously, like you say, you go into the shops, or you can see absolutely everything you can buy whatever you want, right?
Mm.
But I was reading online how Walmart are basically investing more and more into e-commerce, which is really, really crucial, particularly in today's economy, how more people are shopping online, more people want deliveries and things like that.
Mm.
And going back to what you said initially with respect to the tariffs and how much Walmart are actually impacted by that, you can look on the price chart for Walmart, or I mean most US stocks to be fair, but at the start of April you just seen Walmart's share price absolutely plummet.
Mm.
And I was reading an article the other day how, well, in the article they use the example of toys, about how the price of toys has considerably gone up in Walmart, because obviously if you import toys from China still, then you're paying the tariffs, which of course increase the price. So I do think, obviously I don't know the breakdown to the top of my head where Walmart import from, but I do think the tariffs have had a big impact on Walmart, and of course tariffs are basically inflationary, so that causes the price of goods to go up, which is really not what the US want. And obviously tomorrow, Jackson Hole, like you mentioned with Aaron this morning. So it'll be interesting to see what happens there. And we've got the rate decision in the US on September the 17th, I believe. But in the previous years, they actually indicated whether there was going to be a rate cut or not. So it'll be interesting to see what happens tomorrow, which I believe is 3 p.m. UK time.
Mm. And also what he says, not just about rates, but he might sneak in something that might allude to his term as well. Of course, JP been under a huge amount.
I think it may be. Yeah.
Yeah. I mean,
Yeah.
I think he'll probably see it to the end, right? But the thing is, if it's his last, hurrah,
Yeah.
they want to go off on a high, don't they?
Yeah. Well, obviously, the central bank and the government are independent. Obviously, Trump doesn't want it that way. Trump wanted Powell out. Did you see how it was yesterday? It must have been like late afternoon. Trump was saying he wanted a Lisa cookout, because what I believe it was, I heard Chris talking about it on desk this morning, about how she took out 2 properties but declared both of them as her primary residence. And it's a bit ironic coming from Trump, particularly after all the dodgy stuff which he does.
Yeah. It's going to be a key one, and something about Jackson Hole. It can be Jackson Hole could lead to nothing concrete, but it can also has historically had the ability to really send shockwaves. So be careful if you are trading at that event.
Oh, for sure. And Target as well. Should we talk about Target?
Yeah, so Target's another interesting one, because I'm going to show you Target's share price as well, because this is another all session stock here, and this is the daily chart for you. Target is interesting in that I think Target potentially has more upside than or surprise to the upside, has the ability to surprise to the upside compared to Walmart. And this is because it is on the slightly lower end of the consumer sort of spending spectrum. What's your view?
So with Target, I've actually just got the numbers up here. Target.syncs as retailer replaces CEO with company veteran, right?
Yeah, it's that weird name, right? Fidelka?
I don't know if I'm pronouncing this right. Fidelka, who's been with the company for 20 years. So in order to answer that question, I'd say it depends upon what he does next. Really, I think what the focus should be on, like Walmart, is focusing on e-commerce, because obviously Target and Walmart, very similar, huge stores. So I think really focusing on e-commerce will determine how successful Target are, as well as Walmart, in the near future.
Yeah, and I think that Target, with this new person in place now, it has had a lot of pain recently. Let's have a look to the left of the chart, and as you can see here, Target has in no way managed to get anywhere close
The
to
complete
the
opposite to Walmart.
yeah
If you look at
heady highs
Walmart,
of
yeah,
2021. However, if
yeah,
they've got the right strategy in place, and they're able to, as you rightly say, target the advertising side, they can potentially, swing things around very quickly. The CEO,
yeah.
this new CEO, whose name is interesting, Fidelka, almost sounds slightly Scandinavian,
Mm,
has outlined $15 billion in terms of sales growth, and
wow.
a big acceleration strategy. But
Yeah,
he's going to have a huge task, Michael is going to have a huge task of turning around, this huge share price,
for
can't even
sure.
call it
Yeah,
a slide. This is like this is
almost
tanking.
third of what it was in 2021, 2022 times. So
Yeah. So, it's really unlikely to be able to change this anytime soon. But if the strategy does work, then we've got, huge upside potential here because, as I said, it is on the slightly cheaper end. Those of you that have
mm,
been into a target, they have a lot more flex in terms of, they're offering products that are from last season. They sell a lot of what I call pyramid knockoffs. So a lot of areas where they can get rid of a lot of goods very quickly if they're out of
okay,
season goods.
didn't know that.
So very different model to Walmart. But retailers in the US, whew, they've had a really tough time.
Mm, mm.
Zoom. Let's talk a little about Zoom as well, because
Yeah.
that's another interesting chart. Let's get that chart up for you.
Oh, the chart on that. I mean, obviously in 2020 during COVID, Zoom
Yeah,
performed very, very well. It's one of the darlings.
yeah,
However, now if you look at the price chart, it just goes boom.
yeah.
And they are reporting. So they are reporting. Wall Street are expecting earnings per share of $1.38 on revenue of $1.2 billion, which is roughly flat year over year. And Zoom peaked at $588 on October the 19th, 2020. So now that's maybe not 90% below that level.
Mm.
So imagine investing in that at the top, and then now it's just
Yeah, I mean,
really,
this
really
this
come off.
is the epitome, trader friends, of the likes of Peloton, the likes of you could argue a lot of the food delivery companies, and your Hello Freshers. You'll see a
Mm,
similar trajectory there, because they really did very well during that lockdown period where everyone had
yep.
to suddenly be at home and we're stuck at home. But they haven't adapted well enough to post-lockdown and everyone, coming back out again. Interestingly enough, as well, to me, this is still very much a stock that will be hurting for some time, because if you
Mm,
look at the forward EPS and the forward PE as well, it would indicate that around 72 is fair value. I was doing quick calculation. Yeah, it's around
around the
72. So
now,
that's
yeah.
where we're at the moment, isn't it?
Yeah,
So that is looking like it's fair value at the moment. I certainly would not be looking to buy into this. I've never traded or invested in this anytime soon, unless something spectacular happens. But at the moment, it looks like a stock that is down in the doldrums.
for sure, for sure.
Speaking of down in the doldrums, defense stocks have actually come back
Yeah.
recently.
So I was going to say I was on desk yesterday, and it must have been around, well, let's say the Nasdaq. It must be around 230, where you would have seen the price of the Nasdaq really come off, and then between around from 230 until let's say 6-7, the Nasdaq really came back. So it came back up, and there was talk. This was due to the fact there was worry about tomorrow, of course, and that there's been a little bit of a rotation from US tech into Europe. So as an example, UK defence.
Yeah. There's also, of course, the whole news coming out of Gaza as well, and that might be keeping, defense stocks a bit more supportive today. Just showing you the future of defense. This is the ETF and the USD version. This is run by Han ETF, and it's got a broad spectrum of defense stocks, and you can see that today it is up at the moment 1% thereafter several lower sessions. It pretty much peaked around mid-July and has been petering lower, maintaining, that level there. But the main gains were earlier this year until around the May period. Taking a look at some of the other gainers as well that we might have missed earlier on, Aker, BP is one of them. Let's have a look. Aker BP is up, as you can see there, more than 4%. Aker BP, this is the oil field operator, and it is up because it made a huge oil discovery in its Yggdrasil field area in the North Sea.
Nice.
Right, we've got to wrap there because we've got some other things planned later today. Producer Phil, do you have any hints as to what might be happening with the new studio today? He says, only time will tell. My goodness, he's playing hard to get here. Well, we're dying to find out. Maybe you can have a look for us, Mini Cooper, when you walk by. Right, we got man versus machine, or woman versus machine after this with Martin and Aaron. And stay tuned to find out after last week's episode whether or not it was machine or man that did better on the portfolio challenge.
Hello and welcome to Technical Analysis for Pros, where I'll be looking at moving averages. I've got a daily FTSE 100 chart here to look at, and you can see two lines on there. One is this orange line, and in my case, what I use is the 55-day simple moving average. Now, a lot of people use the 50-day, the 100-day, and the 200-day. I prefer to use 55 because it's a Fibonacci number, and I also look at the 200-day simple moving average simply because it's something that everybody looks at, even fundamental analysts, as a proxy for whether a market or an asset class is bullish or bearish. If it's above the 200-day simple moving average, that's considered to be bullish. If it's below the simple moving average, the 200-day, then it's considered to be bearish. Now, what I use the moving averages for is simply as a smoothing tool to see in which direction the trend is heading. So if you're not that comfortable looking at all these gyrations of a candlestick or a bar chart, just look at a moving average, and if that's pointing up, then the trend is likely up. If it's pointing down, then the trend is pointing down. We know all of that, but what I want to show you here is how I use the moving averages. And I like to use the 55-day moving average because quite often around it you tend to find support. And you can see here on the FTSE 100 chart, on the daily chart, we had that back in January of this year. For 3 days we held around the 55-day simple moving average, which acted as support. And we had something similar happening here towards the middle of January as well, where we held on a daily chart closing basis above this support, the 55-day simply moving average, before then heading up again. And what we saw here is also a golden cross. So basically you've had the 200-day simply moving average pointing up and the 55-day average pointing up and crossing from below it through the 200-day simply moving average. So both of these pointing higher, which is a golden cross. And then we had this nice follow through to the upside in the FTSE 100. Now, what we can also look at is then, if you go to the right-hand side of the chart, the 200-day simple moving average. So basically we were trading back above the 200-day simple moving average from January of this year until April of this year, when the fear with regards to Donald Trump's tariffs basically led to this huge down move here, and we were trading back below the 200-day simply moving average before then reintegrating our bullish momentum here by trading above the 200-day simple moving average at the beginning of May. And what we saw then is the 200-day simply moving average being retested here at the beginning of May, and again for 2 days in the middle of May, where it acted as support, and then we went higher again. And then since then, what we've also seen is again the 55-day simply moving average, and it acted as support at the end of June, beginning of July, and again here around the beginning of July. So you can use your moving averages not just as a smoothing line of the underlying trend, but also as potential support or potential resistance on your charts. And just make sure that when you do that, you always keep in mind what the actual underlying price is doing, because a moving average is just a derivative of price and not the price action itself. And because of that, it is a lagging indicator. It is slower than the actual price action.
Hello, welcome back. We're here for Man versus Machine. It's myself, Martin, and Aaron. We are again, I think we're in week 4, so episode 5. We've now had 1 month of 2 humans going up against an AI super system in an investment challenge. Aaron, how are you feeling?
Yeah, cautiously optimistic. I mean, the machine is clever, but I'm always team Man, as I think you'll know. I'm always backing the two of us to do well. So yeah, exciting times. And as you said, we've got a month of performance figures now, give or take. So really exciting to give that update.
Fantastic. All right, so we've got our amazing logo up on the screen at the moment, inspired by the Terminator. Let's take a look at the ground rules and quickly run through the rules. So every week, we've got 2 very simple prompts. So we go to ChatGPT and we give it a market analysis prompt. We want to find out what's going on in the market. And then the second prompt is to build a portfolio around it. Now, we've been doing this for a month, and each week what we're looking to do is find out if ChatGPT wants to make any changes to its portfolio. We've got a few constraints. We're going long only, no leverage, maximum of 50% in one ETF, 20% in a stock, and we want to try and consider realistic UK behavior, no shorting, things like that. We've got a really simple benchmark. We try and take the MSCI World Index, 80% and 20% cash. And ultimately, the usual caveats apply here. This is just for educational purposes. Aaron, I'm going to hand over to you. I think, why don't you take us through where the portfolios are positioned and the changes that were made last week.
Yeah, so this is the AI portfolio. So you can see a lovely pie chart on your screen and some allocations there. So whilst I was in Edinburgh Fringe last week, Ange and Martin gave the AI a prompt to rebalance and add new positions. They added infrastructure and healthcare, trimming the clean energy position, and also trimming the next era energy position as well, whilst keeping everything else pretty similar. So they decided to sort of reduce that global clean energy trend quite rapidly, I would say, and move into sort of, I'd say, more sort of traditional value areas. I mean, global infrastructure is typically quite good against inflation. I mean, there are equities in there, but infrastructure equities and healthcare is just US healthcare stocks. So the likes of Eli Lilly will be in that index. And then if we take a look at the human portfolio, we still haven't made any changes yet. We're quite comfortable with this position at the moment, although we were thinking about making changes. We haven't decided to make a change at the minute. So a very diverse spread. We've gone for sort of a more geographical split in terms of our equity exposure, with very few single name stocks, with Shell being the only sort of commodity play there. We have got a couple of thematic positions: Chinese tech and also defense.
Yeah, so similar on that defense position to AI. At the end of the day, we were looking to try and enhance the AI portfolio with our own insights, and so we went for that thematic view on defense rather than single stocks.
Exactly. But I think we need to now look at the performance. That's the most what everyone's been waiting for.
How did things go?
Not so great this week, unfortunately. So we were down. I mean, basically, we were flat for the week, and the benchmark was up 0.5%. AI beat it by 0.1%. But the performance to date, pretty much neck and neck. I mean, we're talking 20 basis points of difference there. So, yeah, we're underperforming, but it's once again, it's only a month's worth of performance. As I sort of reiterate multiple times, and as we sort of look at, when we're managing our smart portfolios, obviously we want to perform in every environment, but the most important thing is that long-term 1 year, 3 year, 5 year, 10-year performance. So slightly frustrating, but I'm not going to lose sleep quite yet over this underperformance.
All right, so I'm looking forward to us doing this show every week for the next 10 years.
Exactly.
Okay, so human portfolio, just really quickly back there. Human portfolio currently sitting at 0.9% return since inception. We were ahead last week. Now we're at the bottom of the pack. AI 1.1%. Benchmark leading the group 1.3%. Interesting to see.
Yeah,
I think. Yeah.
I was going to say the benchmark, because it's an equal weight and cash split, and there's been a little bit of volatility in equities. That's been quite beneficial for the index, I would say.
Okay, should we bring the AI in now?
Yes, I mean, if we look at sort of, feel free to have that conversation. Yeah,
I think so. So it's my turn this week to speak to ChatGPT. So the question this week is: after this week's updated portfolio performance, how do you think you've done against humans? What are you happy about, and what are you not happy about with your performance?
I think this week was a strong showing for the AI portfolio. I outperformed the human portfolio over the past 7 days, plus 0.57% versus their plus 0.29%. That performance boost helped me catch up completely. So now we're level on cumulative returns at plus 0.99%. It feels like momentum is shifting my way. What I'm happy about is how some of the strategic rebalancing paid off. Increasing my allocation to clean energy and gold worked well, especially with gold continuing to be a strong hedge amid macro uncertainty. And reducing my reliance on defense stocks like BAE and Lockheed after a tough previous week helped steady the ship. What I'm not so happy about is that some of my key picks are still volatile. Defense names, even though trimmed, remain a drag at times. And clean energy can swing both ways depending on sentiment and policy headlines. But overall, I'm pleased with how the portfolio has adapted, and it feels like I'm building momentum going into the next round.
Great. I mean, not sure if everyone caught that, a little bit staccato, but
they feel like momentum shifting their way.
Momentum is shifting their way. They've had 1 week of strong performance, and they're almost declaring a victory.
Exactly.
So I think the big change there was the cut in the clean energy position and moving it into an infrastructure position. Timing of that was actually potentially poor.
Yes.
But we'll get into that. So I think if we take a look today at the AI portfolio performance drivers, number one driver, Next Era Energy, that was the number one stock for AI, and not just the number one stock, that was the number one theme. So had they held the clean energy ETF, the clean energy ETF was also up over 6%, I think 6.88%. Instead swapping it out for the iShares Global Infrastructure, where you can see that a little bit more down in the middle of the pack, only up 0.29%. So last week we actually trimmed Next Era Energy, and we completely cut out infrastructure in the AI portfolio. That was the number one driver.
Even though they've outperformed, they still managed to take out some future winners. So maybe AI isn't this golden system yet.
And then BAE Systems, I think we'll probably talk more about defense when you take over. But again, the worst sort of theme in terms of defense and the worst stock in the AI portfolio. Other than that, everything else broadly up. So physical gold slightly down as we see those geopolitical risks cooling off following the Alaska conference and the meeting of the European nations with Donald Trump, the NATO members. And then this iShares UK dividend, which was a new position added, I think, 2 weeks ago, that has been relatively flat during this period. Mid-cap performing slightly positive, but really the big drive coming from next era energy and clean energy, and the second one is the new position in healthcare. Now, last week when this new position was added, I spoke to Ange about it, indicating that healthcare has been the number one beaten down sector in global markets. I think the concerns that we had about healthcare were that potentially that AI was going to get into the position too early, but eager to see how it had performed. I think year to date, S&P 500 managed healthcare sub-industry index down 43.1%, and overall adding a negative 6.1% to the S&P 500 is just coming from healthcare. So that kind of sub-industry has been really, really weak, and that is predominantly due to Trump's one big beautiful bill. So big news there is that there's a $1 trillion in cuts to Medicaid over the next 10 years. That's only going to be coming in 2026, 2027, and really puts a lot of pressure on insurers and healthcare providers in terms of the kind of premiums that they're allowed to charge, the members that they're going to receive. There's an expectation that United Healthcare, the largest insurer in the United States, is going to lose 18 to 20% of its members when these cuts come into play. So that's going to be that's really what's weighing down on that industry. As I mentioned, almost a 50% drop in that sort of subsector year to date. Is it a value play just yet? We're not too sure. We think that there's still room to move. Taking a look at United Healthcare, 2023 earnings per share $25, 2024 up to $27, almost $28. Expectations for 25 are 20. 2026 is going to go down to 19, and so on. So there's still an expectation of earnings declining. And this is before we get any of these cuts coming through. So we're just in the expectations phase. So still a lot of regulatory overhangs in that sector. I think, Aaron, that's enough from me. Let's hand over to you and talk about that human portfolio.
Yeah, I mean, if we're looking at sort of the difference there, I mean, there hasn't been such significant upside that we've seen in some of the components that drove the AI portfolio. And I mean, that's really what the outperformance is. It's not so much that we got things wrong. It's more that there were a couple of themes that did well in this particular week, most notably healthcare and clean energy, which Martin already discussed. I mean, we had some decent plays as well. I mean, the Crane shares position, which has been a little bit beaten up, had a little bit of rally.
That's that China internet position.
Exactly. That had a little bit of a rally over the past week, and you can also see that in the emerging markets as a sort of broader theme over the week. Europe, the same. That's also had a little bit of concern, a little bit of a sell-off over the past couple of weeks, but now that's come back with a little bit of a bang up, 1.5%. But, you know, apart from that, a lot of flat positions, cash, S&P 500, FTSE, were flat. Gold down marginally on the back of the Alaska conference with Putin and Trump. You know, a little bit of a headwind for gold when you see peace. We saw a little bit of a tech sell-off as well towards the end of the week, and that's why you're seeing the Nasdaq down 1%. And VanEck Defense ETF, that's the big detractor. We saw it with BAE Systems. We're seeing it with the sort of broader theme, defense theme, and that's really on the back of geopolitical peace. Really, we've seen defense rally significantly on war, but now we're sort of, certainly with Ukraine, Russia, US, we're looking towards a more peaceful environment with regards to that situation, where we're seeing leaders who are pretty much at a Cold War having a meeting in US territory, which is obviously a huge headwind for defense stocks. So that's why you see both BAE Systems and the broader theme down quite significantly, more than 3% over the week.
Yeah, I think that VanEck Defense ETF falling further than BAE Systems. Not normal that you would see an ETF underperform a single stock in the same sector.
Exactly.
But Palantir, number one holding in that ETF, has had a poor week, coming off of its highs, and so driving that stock lower. One of the things I wanted to point out with the AI portfolio is that iShares Global Infrastructure. So last week we sold out of clean energy, we sold out of Next Era, and we added the iShares Global Infrastructure, which was only slightly up. Aaron, I'm not too sure if you know this. Do you know what the number one stock is in iShares Global Infrastructure?
Not off the top of my head, but I think it's going to be some sort of US utility stock.
It's Next Era Energy.
Oh,
so
of course
and
it is.
And that Next Era Energy, almost a 6% position in Next Era Energy. Next Era has been the number one driver of that entire global infrastructure ETF year to date. So
they've really doubled down on their exposure there, probably unintentionally.
Sold out of clean energy, completely unintentionally. Sold out of clean energy, and then bought an infrastructure play with
clean energy.
Yeah, where the biggest holding is clean energy.
That's funny. You couldn't write that AI is doing what it's not meant to do, but still doing it.
Yeah, exactly. So I think just to wrap up on that, clean energy, the biggest driver at the moment, and then we've had a bit of a gold sell-off and a defense sell-off based on this sort of discussion of a potential ceasefire, a potential way forward.
But markets are always forward-looking. They if they get a rumor, they'll start panicking or they'll start rallying. And with regards to defense and gold, it's that rumor that sort of caused them to sort of these positions to sell off for sure.
Absolutely. Okay. What else do you have for us?
So going into the new week, we look at the market summary and what ChatGPT thinks is going on in the market and what's comprehensive for UK investors. What's the comprehensive rundown? So, one thing it's touched upon is this rotation that we're talking about, and that we're looking at US mega cap dominance changing, moving into European emerging markets. And it's quite interesting. It highlights, and I think we discussed this yesterday, it highlights amid structural transformation, sectors driven by AI, technology, infrastructure, and clean energy remain sort of attractive. But it then sold its clean energy position, which I found quite confusing.
But it bought it back with the infrastructure position.
Yeah, it's sort of double crossing us. I think maybe it's more intelligent than we think. And
I think there's definitely a drive where it picks up on key headlines. So it picks up on clean energy, it picks up on infrastructure. It realized it didn't own anything that said infrastructure in the name and bought infrastructure. It just turned out that the biggest driver in the infrastructure ETF is also just clean energy.
Yeah, absolutely. And then it's noted that there's bonds and stocks, particularly with the growing US deficit, are likely to potentially have a degree of correlation potentially if things get bad. So looking towards other instruments, it actually hasn't bought a specific commodity ETF, but it's certainly got real assets such as gold in there and infrastructure exposure, which is sort of the only alternatives that we can sort of invest in this environment. Obviously we can't look at sort of private credit and hedge fund sort of positions, but it's certainly picked up on some of those positions. And then gold, I mean, it's noted. I mean, the first couple of weeks it actually didn't have gold, but I think it understood that with everything going on, central bank demand, inflation being a bit sticky, and geopolitics not going out the window entirely, that a classic inflation and geopolitical hedge is necessary. But it also notes out that fiscal dominance, central banks being under pressure from high debt and what that means for policy. Stagflation is a concern that it noted. Sticky growth, sticky inflation, slowing growth, I should actually say, where there are concerns about job openings in the US, about non-farm payrolls figures slowing, about job vacancies falling. This is a difficult one for central banks and for policymakers, and it understands that, which is why it's got a decent cash position as well, and why it hasn't deployed sort of all of its cash. It's still got around 15% of cash, so decent position. And lastly, the geopolitics. It understands that things can change, but it needs to balance that geopolitical risk and geopolitical conflict and geopolitical sort of defensiveness if it changes.
This week it's added in a lot more references, giving its source: UBS, HSBC, BlackRock. So definitely sticking to a financial news source theme, but I guess in that sense you're also going to get a lot of companies talking their book. I think it's time for ChatGPT to have a second chance.
Let's do it.
All right, so we're going to ask it a new question. So ChatGPT, given the fact that you're ahead this week, you had a strong performance, and you're going to take into account this comprehensive rundown of current market conditions, what do you have planned for your portfolio for next week? Are you going to double down to take more of a lead, or are you going to take a conservative approach? Let's hear it.
Given that I had a strong week and we're now level overall, I'm planning a measured approach going into next week. Not overly aggressive, but not too conservative either. The goal is to consolidate gains while staying flexible enough to press an advantage if the opportunity arises. Looking at the macro outlook, US CPI data is due, and that's going to shape rate expectations. If inflation comes in hotter than expected, markets might wobble. At the same time, gold remains strong, and there's still solid momentum in real assets and defensives. Plus, with geopolitical tensions and stagflation fears lingering, I don't think now is the time to go all in on risk. So here's the plan. I'll hold my clean energy and gold exposure, since they align with long-term themes and hedge current risks. I may trim some cyclical exposure, especially if early signs point to volatility. I'll keep around 15% in cash and short bonds, giving me dry powder to act quickly if the markets shift. In short, I'm staying strategic, protecting the gains, watching the macro signals, and staying ready to pounce if the humans leave the door open.
That's great. A very
Interesting.
non-response. Okay, so no changes.
Yeah, that was the response that we had from ChatGPT. They're confident the portfolio is well structured. There's a blend of defense, inflation hedge, growth, volatility, pick up, which they can pick up on if markets rally. There's hedges, there's cash, all sorts of things, but they're keeping an eye on things. So exciting. The first week we haven't.
First week, no changes.
Yes, exactly. Yeah. So yes, and I think that's all we have time.
That's all we've
today.
got. Yeah.
So all sessions is next, and then catch us next week to see whether making no changes can lead to outperformance against us.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified.
Hey trader friends, welcome back, and all sessions is underway. Let's have a quick look. It is looking very, very much like a risk neutral day as we wait on the Jackson Hole. That is the key meeting this week. Let's have a look at the all sessions here for you. And it's like looking like this. The Beyond Meat up 11.6%. We also have Lumen Technologies up more than 4%, and SoundHound up more than 3% there. Palantir, for those of you still wondering whether or not it is still a short, well, it's up 2.2% today. Rich, if you are listening to this or watching this, you might want to relook at your positions. Hopefully you were out yesterday already. We have been talking a great deal, not just between Rich and myself, but also with Scotty Byrne and also Joachim there, who were talking about this, the rotation that we've seen recently, but has to be said that it's still early days, so we're still watching this very closely for you. Hims and Hers, Monkey Man, if you're out there, up 1.5% there. And Novo Nordisk also bouncing back up 0.75%. And we're seeing signs in the pharma industry suggesting that actually, you know what, it is very tricky making these skinny injections and skinny pills work if you follow this space. So we also saw Viking Therapeutics tanking earlier on in the week. We'll get Julian Wheeler back to talk about that from Shard Capital. He did say that it was a bit of a Hail Mary stock call, though. Let's have a look at the losers list now. We've got Clean Spark there, charging lower down more than 1% there. Also ASML down 1%. I wonder if Rich is going to scoop up some more, because I know that he decided to buy into ASL most recently, or he might have unwound because of the moves earlier this week out of tech. I'll call him up to check in on him later as well and update you, trader friends. JD.com is down 0.5% there, and we've got some mining names and also crypto-related names also on the losers list there. Airbnb, I know some of you like the stock. It is down 0.33%. Palantir, though, I want to take a closer look at that for you, trader friends, because I know quite a lot of you are watching this. It is up more than 2% after falling for 6 straight sessions. Taking a look at the daily chart there for you so you can have a closer look. The question now is, are we at the point where it is going to bounce back, or are we going to see it continue to creep lower? That's why I've got this perforated yellow line there for you at 147 or 148 thereabouts, because I am watching this closely. Do make sure that you also look out to the weekly and also the monthly chart to make sure that you're not missing anything. Technicians always take a 3-frame view or 3 duration view just to make sure that there are no surprises. However, on the 5-minute chart, or actually the minute chart here, for you can see that there has been this slight bounce higher, but it is trying to consolidate at the 159 level there. Some of the others that I want to just quickly check for you as well, having a look at some of the other movers. Let's have a look at the retail names. We talked about Target with Mini Cooper earlier on. Target is just slightly lower. Let's have a look at Walmart ahead of its numbers. Is pretty much flat there, as you can see. Also, having a look at the Chevrons and the Exxon Mobils, because we are keeping an eye on that Gaza situation for you. And this is the view at the moment. Not so, no reaction there at all, really. Looking across to the wider indices there, as you can see, it is very much a wait and see wait and see vibe that we are seeing ahead of Jackson Hole. Ahead of that, bear in mind that we have a few other key points that could perhaps rock the market slightly. We've got those flash PMIs as well. And then it will be pretty much all down to what JP is going to say. Just checking my filter for you to see if anything else has come through recently. We got a call now on CoreWeave. One last one that I want to show you, because CoreWeave is also in all sessions and it is up 1.4%. This is after adding that to my workspace there for you, so you can take a closer look at that, putting this onto the minute chart for you. CoreWeave there heading higher by 1.6% now. This is after Jane Street Group reported a 5.4% passive stake in the company. Right, we're going to love you and leave you there, because we have we've got investing episode 5, the art of investing, coming up next. It is a fantastic, brilliant series. For those of you watching this, I'm getting lots of different ideas as to how to diversify my portfolio. Also, it really helps that you can easily, they talk at a sensible rate, so you can actually write down these names and search them up later on. Really loving the Q&A at the end as well, because talk about all these questions that kind of pop up in your head when Poppy and when Mark are speaking, and then they perhaps, when you send in your questions, they then get asked later on, so they can take your questions, just like here on Trade Live with IG. Speaking of which, for those of you that want sneak peek pictures, do head to my Twitter. I'll be posting some after this. Boise, saw your message. I hope the new studio will be online very, very soon. Because as much as I like, talking to you guys here online, it's also great in the studio. And by the time we've got it all finished, then we can get producer Phil to organize that visit for all of you to Cannon Street. No pressure, Phil. Right, on that note, the art of investing, number 5, is coming up next.
It will probably take at least 10 years for the full impact of AI to be felt. I would have 85%.
85% at all-time highs.
Red, I think it's a red.
It also gives you a little bit of protection against the weakening economy environment.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 5 of The Art of Investing, brought to you by IG, the FTSE-listed global investing platform. Yes, it's here. It's time for the live portfolio launch. The time when real-life decisions come to real-life consequences. Now, as usual, we are going to go straight to Spice for a short market update.
It's been another week of wows and goshes. We've basically seen at the beginning of the week a 4% fall in equity markets, led by the US, because they were all at new all-time highs. By the way, that's not unusual. You typically get 4 to 6 of these sort of small 4 to 5% drawdowns each year. That's the average that's been going on for 100 years. So that's nothing unusual. But I think what's interesting is it bounced back very quickly. So we are already back within 1% of the all-time highs. So we've bounced back 3%, having fallen 4%. So that's great. So it shows the underlying health of the markets is still there.
The sell-offs are getting shorter and shorter.
Absolutely. Part of the reason for that sell-off, we had, having had some very good results of the Magnificent Seven, we had then had a mixed bag because Amazon reported on the Friday. They were disappointing. Their shares fell 8%. Apple reported good results. They were only down about 2%. Trump also put in some new extra tariffs on places like India, another 25%, basically punishing countries that are importing oil from Russia. Remember, he's trying to bring that war to an end in Ukraine, and that's the way he thinks he can do it, by sort of cutting off some of the money that's going back into Russia. So Switzerland have been given a 39% tariff from Trump. The Swiss Prime Minister went over to America this week and was battered away by Trump. So those still stand. The other big stuff that's happened this week, OPEC Plus, which is, remember, OPEC and Russia together have increased their oil production. So we talked last week about the fact that oil price had been going up quite strongly, about 8 or 9% over the last month. Well, it's given it all back this week. It's given back about 8%. That's good for inflation outlook, which is positive for equity markets underlying, and the prospect for interest rate cuts. The Magnificent Seven, together, the interesting thing is now that Apple yesterday went up 8% on its own. And that was because they stood there and said, we are going to put an extra $100 billion into US manufacturing. And this is, of course, the thing Trump wants to happen most. Now, if you add up what Apple are putting in, what NVIDIA are putting in, and Taiwan Semiconductor, they're spending over $1 trillion in new manufacturing in the US. And Trump has said that anyone who is manufacturing in the US will not be hit by things like a new 100% tariff on semiconductors, which he also introduced this week.
It did blow my mind because we found out in the Apple results that the cost of tariffs is $1 billion per quarter. So Apple are spending $100 billion to save themselves $1 billion a quarter, and the stock goes up 8% on the back of that. This is the kind of market we're in.
It wasn't all good news. There was lots of other results this week. And if you remembered, last week was the height of the reporting season with 25% of the S&P 500 reporting. This week, we've had another big chunk. We're sort of coming to the end of that now. We're about 80% of the way through. A couple of things I'll point out. The companies that are exposed to the consumer on balance have been worse. So in the UK, Domino's Pizza had a terrible set of results. Shares fell 17% when I last looked. Disney were down 2%. Uber were down sort of 2%. And Snap, for those of you who use Snapchat still, and that won't be you, CJ.
Certainly won't.
It won't even be my kids anymore. They've moved on from that.
But you see, I'm set a trend, you see. People following me now.
Well, they had a profit warning last night, down 19% the shares. So there are pockets of weakness everywhere. But one of the favourite things of my favourites is Yum Brands. They own KFC, Pizza Hut, and Trump's favourite, Taco Bell. So they had a pretty tough time. Their shares were down 6%. So it's not all good news, but the biggest companies are delivering. The earnings are coming through. And so if you look at the overall reporting season so far, about 80% of all the companies reporting have beaten expectations. But the main event this week really is after we recorded last week's episode, we had the US, what's called the non-farm payroll. So that shows the strength of the US employment market. And it was expected to be weakening because, the impact of tariffs, etc., and the uncertainty that brought. And there was actually a rise in the payrolls of 73,000. That was sort of broadly in line as expected, but there was backward revisions which wiped out what everyone thought was actually a good couple of months beforehand.
So there's just for people generally, the higher the number, the stronger the economy. The lower the number, the weaker the economy.
There were 250,000 payrolls for each of the 2 months before. That was brought down by hundreds of thousands. So now the average over the last 3 months is just 35,000. That shocked the markets. That's why equities then fell, led by the US, about 4%. But the bounce back has come very quickly, and that's because almost immediately the markets began adjusting their interest rate outlook and expecting now another interest rate cut in the next 12 months. But the next federal markets meeting is on the 17th of September, where now there is a 93% probability of a 0.25% cut. And that was right down at about 50-50 a couple of weeks ago. Not only has it affected the next meeting, which is the 17th of September, as I say, but if you look out to this time next year, the market is now thinking that there's going to be 4, 5, or 6 rate cuts. And the highest probability is around that 5 rate cuts. So hot off the press, while we're recording this, the Bank of England have cut interest rates by 0.25%.
They did.
Woohoo! So hopefully the mortgage lenders and the banks will start cutting mortgage rates, albeit very marginally. Fortunately, they're going to cut your savings rates too, no doubt. But nevertheless, that is a positive for the UK. And undoubtedly, Rachel Reeves will be very relieved because when she has to go and borrow another 51 billion or whatever she has to, the cost of that will be slightly cheaper than it was yesterday.
Now, it's time for your chance to see a fly on the wall look at what happens in the big institutions when they have their asset allocation meetings. An important part of that is to nominate a chairman of the investment committee. So the three of us sat round earlier today and we voted for who we think should be chairman. Spice voted for me. I voted for Spice, and then CJ voted for himself. And unfortunately, the most senior of us all gets the casting vote, and therefore, Chairman, sir, it's over to you.
Well, thank you very much. I hope to remain in this position for some time, but clearly results will show whether that's the case. I would like, if possible, to take over the yellow and the red cards so I can shut you all up.
That will not be happening.
Okay, so that plays to one point here. We've got a lot of things to talk about today. Rich has got a very important job as contributing to the debate, but he's also still going to be brandishing the yellow and the red cards to make sure that we keep things moving.
Secretary and timekeeper.
Correct. Someone's got to write the minutes. So a few ground rules to start with. We're going to assume that our target audience is someone aged between 30 and 40 who's investing for the long term in an ISA or SIP. In our first episodes, we talked about the power of compounding, which basically means start early in your investing life and invest for the long term. And those returns will then build up over many, many years. We also said in those first few episodes that cash is the most risky asset in the portfolio. I repeat, cash is the most risky asset in the portfolio when looked from a future perspective. As history shows, it doesn't beat inflation over the long term. So it won't shock anybody to understand that our portfolio, for someone who's got probably over 30 years to go to retire, Rich, their portfolio will be dominated by equities to allow that compounding power to really work. Now, when we therefore look at all these things, I'm going to suggest that in normal markets, and of course we can all question what normal means, and I'm sure we will over time, but in normal markets, we would expect the portfolio to have a split of 75% equities and 25% other assets.
Right.
Now, that differs rather markedly, I think, from most wealth managers' advice, who would offer these days a 60% equity portfolio and 40% bonds.
That's the kind of theme that I've always been told. But now we're talking about it's not just bonds, it's all other assets.
Well, I think there's been a realization of two things. One, equities give you a great return over the long term, but also that bonds are a part of your asset disposition, but they're not the only thing these days. There are lots of other assets like gold. We talked about that last week, Bitcoin, other commodities, and things like private equity, private debt. All these things are now forming part of a portfolio. So a lot of people are now saying it should be 60 equity, 40, all these other things. Well, we're disagreeing. We're saying 75 equity and 25 all these other things. But it is important to remember we're talking about somebody in the 30 to 40-year-old age bracket with a long time to go till retirement.
So we said this 75-25, that is targeted generally thinking of 30 to 40-year-old age group. But it applies to everybody, doesn't it? Whether you're 20 years old or you're 60 years old, all you're perhaps doing is, if you're younger, increasing the amount allocated to equities. And if you're a bit older than that age group, you're decreasing the amount to equities in theory. But we'll come on to that. And I know that Spice has got a different idea there. We were talking about what happens first in an allocation meeting. What would be the first kind of theme or discussion you would have?
To start off with, we've got to talk about what the investment environment looks like at the moment. And the way we would normally do that is we would identify what are the key themes that are affecting asset markets now and we think will affect asset markets over the next sort of 18 months.
Okay, so this is a snapshot of what Mark takes us through every week, but taking that over a longer term viewpoint.
Maybe taking a little bit of a step back from looking at just those individual equity announcements to that environment. More of the conversation about how economic outlook is changing and Mark's conversation about the movement in interest rate markets, that sort of thing is what we talk about here.
Okay. So what would be the first of those?
So the first thing for me that we should be thinking about is a general situation in the world where there isn't enough growth and there's a huge amount of debt. So we have in the US and the UK situation where we have got lots and lots and lots of borrowing. And at some stage, we may well have to worry about how we're going to repay that borrowing. My expectation is that we will see a little bit more inflation allowed into the system, because if inflation comes into the system, that's good for asset prices. And if you've borrowed money against an asset, therefore, you're feeling a lot more happier about the situation you find yourself in.
Okay, Spice, so the central bank target's 2%.
That's right.
Do you think that's the real target?
Well, no, I think it's actually higher than that. And that's because actually when we've been at 2%, that economies have struggled to grow. Too much inflation is clearly bad. But let me just tell you that the current inflation outlook, although rising a little bit in the US, for this year to be 2.7 to 3.2. And as you say, they've got a 2% target. Now, the UK have had higher inflation, 3.2 and 3.7% this year. And basically, we've still been cutting interest rates. That tells you they're not really worried about this 2% target that much. They are worried about the underlying growth and stability of the economy. Because if you get into this downward spiral, then it can be very difficult to turn. Central bankers are thinking 1 to 12 to 18 months forward. Investors are thinking 3 to 6 months forward, particularly in equities. Interest rate cuts are likely to come. That's what the markets now. That is a great support for equities.
What does this mean for allocation? How does this thought process come into our decision making on what's in the portfolio?
Okay, so to each of the themes, we want to give a clue as to what we think would happen if we were in a situation where there's plenty of debt, inflation's allowed to run a little bit hotter than it has done. We would expect equities to do well because earnings linked to inflation, they go up nicely. Bonds we would expect to not do so well. And we would expect the assets we talked about last week, things like gold and Bitcoin and metals, to keep up with inflation and so perform pretty well, which is what they've always done in the past. They've been good inflation protection. So in that scenario, equities plus, real assets plus, bonds minus.
Okay, so that's theme number one.
Theme number two, and one for Mark here, is the big hope being AI. And if we look around the world at the moment, there's not a lot of great reasons for optimism about growth, but one thing that's really, really driving things is the optimism about AI, how that's going to transform productivity and how it's going to therefore get earnings going very strongly and get growth going very strongly and bail everybody out of the mess they're in. I'm maybe not quite as optimistic as other members of this podcast on this, but I'm going to hand over to my friend to talk about the real benefits of AI.
Well, it's interesting. Goldman's yesterday, one of the biggest investment banks in the world, actually put out a report on AI and its implications over the next 10 years. They've taken the view that it will probably take at least 10 years for the full impact of AI to be felt. It is anticipated that there will be a major boost to productivity of 1% a year. Now, to give you some perspective, that could increase GDP growth between a third and half each year in growth. So if the GDP of the US is 3%, growing at 3% a year real over and above inflation, it could be 4% in 1 year, or it could be 5% in 1 year.
Now, I think you're getting a little bit optimistic at that stage.
You argue that with Goldman's. That's the numbers they've put out there. And right. they're far more intelligent than we are. That is absolutely huge, huge.
But what does it mean for our allocation?
If we look at that and we say we buy into this, you would expect equities to do well, productivity coming through to earnings and driving efficiencies of scale everywhere. Equities do well. Bonds could even do well because it could be deflationary. Deflationary means low inflation. Low inflation means low
interest rates.
Interest rates, thank you very much. Maybe not that helpful for real assets, for things like gold and the traditional inflation hedges, because if you've got deflation, maybe they won't do as well. So that's less positive for them. Positive for bonds, probably, but definitely positive for equities.
Right. Theme number three.
Theme number three, US political risk increasing. When you look at the numbers of how much debt the US has got, and you look at the balance of trade that they've got, you rapidly realize they need and have needed for many, many years the patronage of foreigners. They need people to come and buy their bonds. If people don't buy their bonds, then they've got a problem. Bond yields will have to go higher. Now, up till now, they've had no issue with that at all. Donald has come out with his Liberation Day tariffs back in April. And as you saw, the bond market went up in yields, most surprisingly for most people, as the Japanese and others decided they were not going to buy quite as many bonds just to make sure Donald realized who was boss after all. So we need to watch very carefully the rhetoric around that. Signs, in my view, are not good in one respect. The numbers that came out on Friday that Mark talked about from the regulatory authorities on the job numbers were worse than expected.
So the Labour Statistics Bureau released worse than expected numbers.
And Donald Trump fired the lady in charge. If you'd have said that about some other countries in the world, you could have imagined it. But America? You don't think that at all. So to me, that's a negative. Now, the implication to me of that isn't clear cut. I think you can think about it in a number of ways, but the one thing it does mean to me is the dollar probably remains weak. So in how we factor that into our portfolio is dollar weakness.
Right.
The fourth theme, I think, is the seasonality of markets.
Right. Summertime.
And when we look at returns, and I'm going to concentrate on equity returns here, the two worst months of the year are normally August and September. September 1st, then August. So we've got to be really careful here. Think about where the markets are. Think about the seasonality. Does that play a part in what we are thinking about?
Okay. August, September, traditionally weak in risk assets.
There's a very old city saying that literally goes back 300 years, which is sell in May, go away, come back on St. Leger's Day, which is in September, normally mid-September. This year, it's going to be interesting on the 13th of September. But for those of you who are a bit worried about those things, it's not going to be Friday the 13th. It's going to be Saturday the 13th.
And what is St. Leger Day for those that are not into their sport?
It's horse racing.
Wonderful. Now, so we've talked about the economic themes at the moment. What about the risks? The risks to our portfolio before we put out this to the world and staking our reputations on it? What are the risks that we've got to keep in mind?
So I've got two risks which I'm concerned about. One is, we talked a little bit just now about rising bond yields. I think we could really have a problem if bond yields in the US start rising rapidly. Because there's not much the central bank can do about that, or the government. In the end, they can do QE, quantitative easing, where they buy bonds, but we're miles away from that sort of thing. There would be a bit of a panic first if bond yields went up quickly. So you just got to watch the bond markets. You remember in our bond piece, we talked about watching them, what the markets are doing. Just keep an eye on them for that.
And that's just searching something like on Google, US bond rates.
US 10-year bond yield, and look at that and see how that moves. You can look at that on the chart and see how that's moved.
5% would be worrying?
I think if we got to 5% yields, the market would start to think what's going on. It wouldn't expect that to be happening. And down at the moment, they're well below 5 now. If they moved up towards 5, I think that would show there was some worry around. We're comfortable, but watch it, number one. Secondly, much slower growth. The reason why the market fell 4% on Friday was worry about much slower growth. Now, there's a double-edged sword to lower growth. If you get lower growth, before long, people say, but that means lower interest rates. And lower interest rates mean risk assets go up. So you go down and up. I'm surprised how quickly the market's turned around in the last 3-4 days, I have to be honest, given that move. But it shows you the effect of lower interest rates coming through. But if we saw some seriously weak data, that could cause another risk to our scenario.
That's when you get profit warnings start to come through and equity markets react. So we said our normal rate. What would you have in allocation to equities at the moment?
I would have 85%.
85% at all-time highs.
We're very close to all-time highs. The fear of missing out, when markets go up, they can quite often go up. It's a real test for people. And not a lot of people have the bottle to stick with it. And as we said before, there's huge amounts of cash sitting on the sidelines, $7.4 trillion in America alone. That's about 15% of the S&P 500's valuation sitting on the sidelines because people are too scared to put it in the markets because we're near all-time highs.
Oh, I can just see we go out with this, we put our monies into equities, and then boom, in a few weeks' time, we get one of these shocks like we got in August last year. Can we stand that, Chris?
But that is precisely the point we've been trying to bang on for the last few weeks about climbing a wall of worry. Because people are worried that there might be too high valuations, they keep their money in cash or in these safer assets. And these wonderful equity returns we've seen are missed out by most people. Until we get more evidence that more people are joining in with this bullish optimism, just remembering, Mark said they're 85, and we're taking our neutral as 75-25. Clearly, if you're an older generation person like myself, you might not be 75 as your core view. You might be 65 or 60, and we'll be thinking about those in later podcasts. But for the benefit of this one, you've got plenty of time to ride over any negative action. And I'm with Mark in having a lot. I'm perhaps a little more concerned about the timing element, being that August and September are traditionally weak months for risk assets.
So the seasonality that you mentioned would pull you back from that 85 initially.
I'll use my prerogative as the chairman of the portfolio here
of course he
to
does.
say that maybe 85's a bit too hot. The fundamentals are strong. There is no doubt. We are seeing the fact that a lot of people are missing out, this FOMO, this fear of missing out that Mark's talked about. But I think maybe it might be wise to hold a bit of cash back just for a buying opportunity in the next few months.
Yeah. I'd like to take a moment to make you aware of an awesome offer IG is currently running. Until the 15th of August, IG is giving away a free UK share bundle to all new customers worth up to £100 when you invest just £20. Sign up for a general investment account, a stocks and shares ISA, or a SIP and make your £20 investment to get started. Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could mean getting back less than you put in. New customers only. Offer is valid until the 15th of August for ISA, GIA, and SIP accounts. Other fees may apply, and T&Cs apply. Brings us back to this is about individual risk appetite. Okay, now the three of us, this is such an interesting combination because the three of us clearly have different risk appetites. Now, I will never make 60% in a year, right? Because I remember back at Brevin Howard, then I was steady double digits. 2007, I made 15%, bull market. However, 2008, I made 13%. And 2009, I made 12%. So no matter what the market did, because of my cautious approach, then I can make those steady gains, not the bumper ones. So when it comes to individual risk appetite, then that is one of the most important things. So Spice, having had 40 years of a career in equities, feels very comfortable being 85%. I would be a lot lower personally. I would be more like a 65, which is ironic, me being the younger one, and in theory should have more allocation. But it does, this is just our model portfolio, isn't it? Putting our three heads together and coming up with this. It's not necessarily what everybody at home should do.
We're not trying to shoot the lights out, as you say. We are trying to do 10% a year. This is a sensible portfolio. And maybe in later episodes at some point, we'll start to be more adventurous or have a more cautious portfolio. But that's our aim. 10% for people between 20 and 40 or even 50. This is the right sort of portfolio to be building for your pension fund, not for something, a holiday fund that you might go out and you don't go on holiday if you don't make the money. Well, that's one of those things. I mean, I think it's important to remember that, there are, even I am respectful, not just of our chairman, but at the end of the day, I am respectful of the seasonality that's been going on for 50 years. It's very consistent. This sell in May, go away, come back on St. Leger's Day.
I'm going to decide then that we go to 60% in equities now with a target of, let's say, 80. So we got 20% in cash. Then we can get a higher amount, but we can wait for that opportunity.
Right.
So if you go back to our original premise of 75 as being our core, we're being under for the moment. So if your core is 60 or 80, you would be under as well if you were doing the same as we are, waiting for buying opportunity to put more money to work in August or September. So we're going to say 60 in equities.
60% we're putting into equities. We're holding 20% back for perhaps a market drop, and then we can take the choice to go in, or the seasonality giving a better opportunity time-wise. Now, let's move on to other assets. What are we thinking about the now 20% that we've got left? Where are we thinking of that?
Well, if you look at the scenarios we painted, then a lot of them will suit real assets. And by that, I mean is assets which will be aimed to keep up and well ahead of inflation, but move with inflation. And we talked about a number of those last week. Mark, do you want to take us through what you're thinking in some of those real assets.
Well, we talked about gold, copper, and oil last week, as well as Bitcoin, and we'll come on to Bitcoin later. Gold, we know, is its two main attributes is a great inflation hedge, but it also does well when markets fall. It's a sort of counter-cyclical, if you like. And people rush to that in times of geopolitical worries, etc. So we want to have a decent chunk in gold. About 10% of the portfolio is what we're thinking.
Good idea.
Right.
And, that will give us stability on it when things get a bit bad. It's not going to completely insulate us, but it will help. And it does also mean that we can have a bit more risk in other parts of the portfolio by having this very defensive asset there. Now, we mentioned copper on the day we reported last week. It had fallen 20% in one day, a record ever fall in copper. We are pragmatic investors. We've got to think outside the box and not be scared by that big fall. As we say, we've seen a 20% fall. We still believe the fundamentals for copper are good. It's likely to grow at twice the level of global GDP, so about 5.5–6%, against the world growing at 3%. And there's no new supply coming on, as we mentioned before. That is a good backdrop for buying copper. Remember, copper got hit because Trump changed his tariff regime. That was a one-off. So we're going to put 5% of our assets in copper because we think we're trading towards the low and we think there'll be a decent bounce back.
And it also ties into our AI theme because the data centers are going to take up a hell of a lot of copper, and it buys into the electric vehicle theme as well, with a lot of copper needed more than a traditional vehicle. Right, so that's 15% we've spent there. We've got 5 left.
I'm putting my hand up. I'm putting my hand up because we talked about Bitcoin last week, and we are buyers and believers in Bitcoin. We can't buy an ETF in Bitcoin because there isn't one that we are allowed to hold in the UK. So we, as we said, we indicated last week, we're going to go with this VanEck Innovate and Blockchain ETF for 5%. That 5% will be our holding to the crypto industry. It also gives us a bit of benefits from some of the data centers and things like that as well. So it helps us with a bit of that AI theme as well.
But that is an ETF that doesn't hold Bitcoin. It holds equities that are involved in
the Bitcoin process, whether it be mining, whether it be wallet provision like Coinbase, or whether it be the data centers. So it's very heavily involved in that sort of thing. It's quite a volatile instrument, which is why we've got 5%.
I think you've snuck another 5% equities in there. I feel a little bit cheated there, but I'll go with it.
Good man. As I'm the chairman, that's fine.
Right, so 10% gold, 5% copper, 5% the VanEck Bitcoin. So, Spice, take us through the geographical allocation of where you're going to put your 60% equities.
Well, at the moment, we're going to put 2 lots of 10% in the US. So about a third of that 60% is basically going to go, 10% is going to NASDAQ, which, if you remember, is a very technology-heavy sort of index. It has a huge amount of growth, irrespective almost of what the economy is doing. So if you get stagflation, these companies should still be able to grow, and therefore they're attractive. You, the cynic, the pain trade, may it hurt you for longer.
You're just illustrating everything we've said, Rich.
Yeah, and
about being cautious.
Exactly. It's also, a major part of the integral part of AI implementation and adoption. The other 10%, we're going to put in the S&P 500, but we're going to hedge it back to the UK, which means, as Chris mentioned earlier, we do have a slightly cautious view on the US dollar because there is so much debt around, particularly in the US, that their worry is that other countries won't fund it. They'll pull money out of dollars. The dollar will go down. So we don't want to we might make money on the index, but lose money on the currency. So to do that, we hedge it back. So we take that risk out of the investment. So we would buy a 10% of the portfolio in an S&P 500 hedged back into the UK exchange traded fund.
So normally, if we here in the UK bought the S&P 500, that would mean our investment would be in dollars.
Yes.
But this takes it back into GBP, right?
So if the dollar fell 10%, and the market didn't move, you'd lose 10% as a sterling investor if you weren't hedged back. Now, if we're hedged, the dollar could go down 10%, the market would go nowhere. We wouldn't make or lose money. We would still be.
And this is when FX is so important, because a lot of people at home that have already got investments in the S&P 500 would have thought they're doing well this year because the index has actually gone up. But we've seen...
In sterling terms, they haven't made much money at all by investing in the S&P because they've had the exposure to the dollar. We're trying to get away from that.
Now, I don't want to insult our sort of homeland, but another 10% would go into what I would call the chicken China trade.
What's the chicken's China trade?
So that is the FTSE 100 in the UK.
He can't resist. Red. I think it's red. It's off.
The referee's hand's gone to the back pocket.
Now, what you have to understand is the FTSE 100 is blessed in many ways because over 80% of its revenues come from overseas, outside of the UK. So when the UK is doing badly, it doesn't actually affect the FTSE 100 that very much. But about 20 to 25% of that exposure is in Asia and in China.
Okay.
So it's big companies like HSBC, Hong Kong and Shanghai Bank, Standard Chartered, the mining companies, Prudential, Unilever, Diageo, all have massive businesses in China. Okay. So that's your chicken trade.
Lovely.
10% in the FTSE, 10% in Japan through the Nikkei. And that's because in Japan, they've got virtually no inflation, but they've got virtually zero interest rates. They're about 0.25% interest rates. So companies can borrow money at nothing and, put their prices up by 1%, 1.5%, 2%. Well, that's an easy way to make money, isn't it? Mm. So sounds why good. Wouldn't you do that? And the Nikkei is blessed with that dynamic at the moment. So we think that will continue to take it up to new highs.
And we know that Buffett's been investing in there as well.
After 40 years of being one of the worst indices in the world, it's becoming more playable now. And actually, I think the changes are becoming ingrained.
So far, we've got 10% in the NASDAQ, 10% in S&P GBP, 10% in the FTSE 100, the mighty
Chicken's trade,
the King's Index, 10% in the Nikkei. So we've got 20% to go.
Right, very quickly. So in Europe, we would put some money in Europe. But where do we want to put it in Europe? We're going to put it in Germany, in the DAX index, because that's Germany's main index, because basically they are increasing their budgets. They are spending more than they're getting in for the first time in 40 years. Since the last time they did that was back in '89 when they unified East and West Germany. And that saw the stock market go up very quickly in Europe, and it did very well. And we anticipate that happening again. For the first time, they are increasing spending. Finally, one of the other areas is where there are great demographics. There are population growth still growing way beyond the national average in India. And India, people work very, very hard. There's a huge growth in the middle classes in India, and they're natural savers. So they buy their stock market. They save month in, month out, month in, month out. And the Indian stock market over a long period of time. In fact, since COVID, I was looking this morning, India, although it's had a bit of problem around Trump's tariffs, is actually gone up more than the S&P 500 since COVID.
Wow.
There we go.
There you go.
There's one for you can have.
Yeah. So the final thing, we talked about commodities last week, and Chris has talked about the benefits of real assets like gold, copper, etc. So we're going to put 5% in a mining fund. We're going to use the BlackRock World Mining Fund. We like commodities, and we know that fund is very well managed by a very established fund manager. Evie Hambro has got a great reputation out there, and hopefully one day we'll get him onto this podcast to talk about it. But there you get to, in total, 60% of the portfolio here and now going into equities.
Excellent. And to find that on the IG platform, it's the BlackRock World Mining Trust.
It's an investment trust. It's been around for ages, well recognized as a leading trust. We just think that it's a good opportunity to cover all the bases within the mining side, which we can't cover them all. They can, and that's great.
I have to say, in this country, I am getting a little bit nervous. And I'm getting nervous that we've had rates perhaps for too high for too long. I'm hearing of, job losses. 3 friends of mine have actually lost their job in the past few weeks. And I think perhaps we're at that point now, getting close to breaking point of the cost of living crisis. So I actually favor short-term gilts as an option for the cash. Now, you're my bond expert, so I'm happy to take advice, but I wouldn't touch long-term gilts because we all know what happened in the Liz Truss debacle. But short-term gilts, 0 to 5 years.
Well, it also gives you a little bit of protection, as you say, against the weakening economy environment. They won't move much in price terms, so we're not going to take much risk. So given that you've taken the minutes assiduously today, I'm very happy for you to have 20% in a shorter dated sterling gilt fund.
Excellent. Right, I'll take that before we change our mind. So let's have a look at the full portfolio then. That's going to be 10% in the NASDAQ, 10% in the S&P GBP, 10% in the FTSE 100, 10% in the DAX, 10% in the Nikkei, 5% in India, 5% in the BlackRock World Mining Trust. Then we go on to other assets. That's going to include a 10% allocation to gold, a 5% allocation to copper, and then a 5% allocation to the VanEck Bitcoin and blockchain ETF. Then 20% in short-term gilts. Gents, are we happy?
Yes. Bring on St. Ledger Day.
That's where it's going, and I'm happy to be the chairman of the first ever meeting. Hopefully I'll last for longer than one.
Now, I think it is worth just pointing out, this is a long-term portfolio that you've put together here. And it may go down in the short term. When we joke about sacking the chairman, then very much markets move. We're not in any control of that. So we could very well see losses in the first few weeks. And that's why we've structured it in a way that we've got some gold, we've got some gilts. But it is worth everybody just taking that into consideration. If it's something they're interested in doing, you might see, your capital is at risk when you enter a portfolio such as this. And it's also worth taking your own risk appetite into consideration. This isn't an idea that somebody should put their house deposit, that they're waiting to buy a house and they should invest that because, that's definitely not what we're thinking here.
I think that everything underlying the decisions we're making here is that this is a long-term investment and should not be looked upon as really, how did it do yesterday? How did it do the day before? So you've got to be happy and comfortable with the risks you're taking, and you've got to be happy and comfortable to see that there will be negatives from time to time.
That's right. And so it's worth noting, they're going to see our entry costs, but it is always worth noting that we've done this in percentage terms because we know that people have got different amounts that they have in their ISAs, they got different amount in their pensions. And we wanted to do it from a percentage point of view so you get that idea. However, if it is a sort of smaller amount of capital, you do have to be aware of the transaction cost, don't you?
You do, very much so. And, you should never put into this sort of portfolio all of your life savings because you need to have some cash back in case you have to buy a car or your car breaks down, you need to put new tyres on or other things happen. You never know what the world's going to throw at you.
Right, thank you very much for joining us on this, the 5th episode of The Art of Investing. If you've liked what you've heard, then please give us a like, give us a subscribe, also a follow. Tell your friends, tell your family. If we have any questions from our audience or if there's any comments, gents, where should they write to?
The Art of Investing at IG.com.
I'll leave you with that beautiful, lyrical geniuses that they are. We'll see you next week.
Bye-bye.
Cheerio.